Good morning. Welcome to our Q3 Market Outlook with myself, Isabelle Zhen. I'm a warrants issuer at Kenanga Investment Bank Berhad and the head of equity derivative sales, retail equity derivative sales. And we'll be joined by our guest today, Mr. Kevin Liu of CICC Research. He's the managing director and he'll be joining us in just a few minutes. That's him on the screen right now. Hello, Kevin. Before we get started, some house rules. So today's session will be split into two. For Q3 Market Outlook, we have a lot to cover, and I know the concentration span is very short for a human. It's only about an hour or so. But we'll be doing 45 minutes of Mr. Kevin's session, where he'll give you the outlook for the Hong Kong and China markets, followed by a 15-minute Q&A, where I encourage you to turn on your mics if you want to. You know, I would love to hear your voice. It is quite boring to hear my own voice over and over again for these past few months. And if you don't want to, feel free to type them out on the chat box on your side. After that, it will be a 45-minute session with structured warrants, which is with me, followed by 15 minutes of Q&A as well. Today's giveaways will be structured in this way. We're giving away 10 Shopee vouchers worth 100 ringgit, and these will go to the best Q&A questions. The best way to learn is actually to, number one, ask questions. Number two, which we're encouraging you to do, right? Ask questions. I want to incentivize you to ask some questions and, you know, get your brain juices flowing on the Saturday morning. The second best way to learn is to teach others. So whatever you learn today, if you post your 3 key takeaways on our Facebook group, our Facebook for Kenanga, that is, that's Kenanga group, we'll be giving away 3 Garmin watches for those 3 key takeaways. So watch the whole session, think about it, and the closing deadline will be tomorrow, Sunday, at 10 p.m. So, you know, think about what your 3 key takeaways are. I don't want you to write a whole essay, okay? Just some short and sweet things. It's not karangan in secondary school, okay? Short and sweet 3 key takeaways, and we'll be giving away 3 Garmin watches. And those are our giveaways for today. And so, ask questions, 10 Shopee vouchers with 100 ringgit each. Teach someone else, write down your 3 key takeaways. And of course, the third best way is to do. So to encourage you to do, we've got a Garmin campaign next month. It's going to be running from 1st July to 31st July. And the mechanics of it is that you just need to send your screenshots. So for the entire 2020, what year is it now? 2022, right? For the entire 2022, if you've actually made a Kenanga warrant trade that is profitable, just send a screenshot to our Telegram, and the first 10 every single week will win 100 ringgit Shopee vouchers, and we'll choose a winner every week for those Garmin watches. So ask questions, number 1. Number 2, teach others, right? It makes you process the knowledge differently. And number 3, you gotta do it. Or else you're just attending a webinar for 2 hours and you have nothing to show for it by the end of 2022. Anyway, those are just the house rules, and we'll get started with our first speaker. This week, we're going to be having Mr. Kevin Liu from CICC Research. He's the managing director over there. And he's the best person to ask about Alibaba, the Ant IPO, because CICC is the one that handled it. So without further ado, Mr. Kevin Liu. Morning, Kevin.
Good morning, Isabelle. Hi.
How is it over there? Which part of China are you in?
I'm right now in Beijing.
Awesome. All right. We'll leave it to you then. Thank you so much, Kevin. Over to you.
Sure. Thank you, Isabelle. Good morning, everyone. My name is Kevin from CICC. I'm speaking from Beijing. Today, I'm very honored to have the chance to be able to share with you our latest reel regarding Chinese market. I actually like this today's topic quite a lot, saying that there's always a bull run somewhere, right? And what we need to do is try to figure out where it is and try to find the good timing for those opportunities. So hopefully today for this presentation, what I'm going to show you is how we look about China's market, both H-share and A-shares market going forward, and hopefully could provide you some useful information regarding your investment going forward. So again, happy holiday, happy weekend, and good morning. I will start with the market outlook for the second half for Chinese A and H shares. At this point of time, we all know Chinese market actually has some challenges and experienced some hardship in the second quarter. The COVID condition, the geopolitical tension caused the market volatility and correction in both onshore and offshore Chinese markets. But fortunately, over the past few weeks, we see signs of improvement. We see signs of improvement in both economic activities and also the market responses with notable rally. I bet a lot of investors do have questions regarding whether we are already behind all those challenges is behind us, or whether we're going to see more challenges ahead, whether the current rally is going to be sustainable, and what kind of opportunities going forward is the best part to bet on Chinese potential more policy support and economy rally. So that's what we're going to figure out for the next 40 to 45 minutes for my presentation. As you can see, our key message want to deliver today for H shares we want to emphasize is what we call relative resilience. Relative resilience. I think it's pretty. I think it is pretty good. A good summary of recent performance of H-share market, especially if you consider if you put that in the context of global market volatility. For example, the U.S. market volatility, the Nasdaq's correction against the backdrop of Fed very hawkish tightening. The H-shares still deliver a quite notable rally. And A-share market, we want to remind investors to still watch for some challenges, but we want to suggest investors to pose for future opportunities. That's our key message we want to deliver today for you. Let's start with the first message of the economy cycle. I think one of the key things, one of the key trends we need to bear in mind is the economy cycle for China is kind of a divergent with global markets. It's kind of a diverging again. China has been experiencing experiencing economic slowdown since last year, since the second half of last year, coupled with some challenges, for example, COVID condition and also geopolitical tension caused the hardship in the market. But again, we see Chinese policy already turning to supporting side of the economy, monetary policy easing, fiscal supports, meaning that China is leading the global economies, especially the developed markets, which is heading to slow down, which is heading to more tightening ahead. China is kind of around the inflection point to pick up again. If we can, if we can make sure the earnings, the growth will, confirm its inflection point to pick it up again going forward, it's gonna give you another divergent path, which is China is recovering while the rest of the world, especially the developed economies, is slowing down. That will give you a so-called relative resilience and comparative advantages in Chinese equities, especially considering Chinese equities For example, the H shares are trading at still very cheap valuations and relatively underweight by global investors. That's the key theme. That's the key trend when you consider, where to put your money, how to allocate among different markets. That's the key message. First key message I want to deliver today. Let's look at the updates regarding Chinese macro and market condition. We all know that Chinese economy is slowing down since the last few quarters, but fortunately we see policies has been stabilizing the growth, trying to support the economic growth rally ever since the end of last year. Although there are disruptions of COVID condition, although there are disruption of geopolitical tension, we see more policies to step up with support, try to boost another round of economic growth recovery. So a few key summary points before I start with the details I want to highlight for Chinese market and the economy. First, global-wise, we see that the trade right now is going from trading stagflation to trading how to out of stagflation. So given such backdrop, investors are trying to find growth opportunities, meaning that they try to find where the assets still could provide better growth potential or at least recovering potential with relatively solid balance sheet and what is even better operating cash flow. So that is why we have to remind you of the growth trend divergence. China is kind of picking up in growth with policy support, while the rest of the world is slowing down. The only thing we have to confirm right now is whether we can get the inflection point of the growth, going forward, which is about around, according to our estimation, which is about around the third or fourth quarter. So the global environment actually right now gives us the opportunity to try to find more growth or at least comparative better growth in China. In Chinese market, especially for Asia market, I have to say, admittedly, there are still challenges. There are still challenges from domestic growth slowdown, for example, the COVID condition, the property market. So we still have to wait for more signals of growth inflection point, but we still want to suggest investors to be alert for opportunities because we have the support from the policy, we have the support from the valuation. What we need to do right now is to try to find more clues of growth stabilization and the inflection point. When we get the confirmation, we can switch more to the growth sensitive sectors. But before that, you can see the growth sector, which is the relatively less cyclical part of the markets, are actually being favored more by investors due to the easing liquidity stance and monetary condition. So that's where we stand right now. First of all, let's look at the policy cycle. The policy cycle actually has shown very clear signs of policy easing ever since the end of last year. We measured that using total social financing. You can see the total social financing has a very close relationship with the market trend, which basically give you the idea, where we stand regarding the liquidity environment and the monetary policy cycle in China. We started to easing the liquidity condition. We started to easing the monetary policy since last year. So this actually gave us a prerequisite for market to pick up and also for growth to pick it up. So it first reflects in the liquidity condition to support the valuation, to support the sentiments, and then it will gradually trickle down to the corporates, to the corporate profits, to the corporate earnings, and more importantly, what we need to wait for is corporate capex cycle. We have been through several rounds of policy stabilization, cycle over the past few decades. Apologies for the tax-heavy slide on this page, and you probably cannot see clearly of those tax-heavy table. But the key message I want to deliver on this page is that if we look back of different rounds of stabilization policies, we can see there is a pattern. There is pattern whenever Chinese policymakers try to stabilize the growth. It always works. It's just a matter of time. It's just how we do in China. But everyone is different because what the policy want to address to is different problems, it's different challenges. So we see, every time the policymaker actually emphasize more flexibility, and more importantly, that when they use the cross-cyclical adjustment, they want to do it more flexibly and more to the point to address to the key issues. But different time, we have different issues. So that means we cannot directly borrow the historical experience, but the mechanism is kind of similar. The mechanism is kind of similar as the policy started to introduce more support. If you gradually trickle down from the liquidity side and then to the corporate confidence side, to the consumer confidence side, and then trickle down to be reflected in the growth. So roughly, according to historical experiences, it normally takes 2 to 10 months to see the bottoming of economic growth. So if we look a little bit, we take a step back to look at when we started to have the policy support, which is around end of last year. So that probably give us the potential bottoming of corporate and economic growth around the third and fourth quarter of this year. Actually, if not due to the COVID condition in the second quarter and the disruption of geopolitical tension, we're probably going to see that inflection point earlier. But the key message here is really, if we borrow the experience of the different rounds of stabilization policies, it usually works. It always works. It's just a matter of time. And how we evaluate, how we see the effects of the growth recovery. One of the key message is the corporate capital expenditure cycle. That actually gives you a very strong signal and probably a long-lasting signal to suggest that the corporates, the management, and the CEOs, the confidence in investing their future will gradually pick up. That is why whenever you see the capex cycle starting to pick up, it normally, coincident with the market cycle. We see the capex cycle slowing down over the past 1.5 years, and right now we are waiting for the inflection point in the capex cycle. That's kind of a lagging indicator of the economy of the monetary easing. But that's the very important leading indicator for the future growth and for a more sustainable earnings recovery and the market trend. So right now, if we want to define the market phases, it's probably the expectation of the policy support to reflect the valuation and sentiment recovery. But if we can confirm the capex cycle and the growth cycle, the inflection point, that will give you a more sustainable rally or upside room supported by the earnings, supported by the growth. That's how we look at the market. But there are still challenges. I don't want to ignore the challenges facing China. We still have to bear in mind there are challenges, and we still have to watch for those challenges. So that is exactly the reason. That is exactly the reason why I say, there might be volatilities, but we are alert, we are poised, we are prepared for future opportunities. The first challenge is what we call the COVID condition. We know that the COVID condition has been a notable disruption in China, especially in the second quarter for growth in key cities like Shanghai and Beijing. Take myself for example. I'm in Beijing. I actually worked from home in last month for the whole month of May. I recently can get back to office starting from mid-June. So you can see that there are still disruptions due to the COVID condition. And the best case scenario we expect going forward is that it's still going to be there for a while. Unfortunately, it's still going to be there for a while. I mean, the COVID condition by using the regular testing. So right now we are still required for at least testing of a negative test for the past 72 hours to be allowed to enter the office and other public places. So we are trying to use the regular testing to fight against the COVID condition. So that's going to be a still disruption there. But the bottom line is I don't think the extreme cases, the extreme shock in the economic growth, like what experienced in Shanghai, will repeat itself again. Because that's the very notable, that's the very extreme shock to the economic growth and very extreme cases of lockdown. Other cities, including Shanghai itself and Beijing, will definitely learn the experience from last round of the lockdown in Shanghai, meaning that they will adapt regular testing, try to prevent another occasion of extreme cases, extreme lockdown. But that means the long tail, the testing and long tail effects of economic activity to a certain extent will be there. But I don't think the extreme cases will repeat itself again. So that's basically gives us an idea that the growth bottom could probably already behind us. Although it's going to take some time for the economic activities to fully recover, but the bottom is probably already behind us. We don't expect the extreme cases in Shanghai will happen again. You can see from the manufacturing PMI, it already rebounded to pre-pandemic level. That's very easy to understand because the manufacturing activities normally recover more quickly compared to consumption. The consumption, the travel will take time to recover gradually, but it's on the path to recover. It's still on the path to recover. And in order to fight against the negative impacts of the COVID condition, we see the policy efforts actually ramp up in April and May for both physical and monetary policies to support those most affected sector and households to weather through the hardship, the challenging time and hardship of those COVID disruption on their ordinary living and operations. The fiscal expenditure, the local and the government bonds, insurance and loans all jumped up notably in the second quarter to fight against the disruption. So the key message here is that we still have to watch for potential challenges due to the COVID condition, but we don't think the extreme cases, the extreme lockdown condition in Shanghai will repeat again going forward. That means the worst part of the growth is already behind us. The second challenge facing China's economy recovery, or should I say, the second challenge is facing Chinese economy to recover, more rapidly, is still about its property sector. We are definitely already entering what we call the post real estate era. We don't expect to rely heavily too much going forward on the property sector. It's not a sustainable trend. We all know, the rationale behind, but you have to bear some negative effects, especially the growth is slowing down, because property sector is such a big important part of the Chinese economy. So what we have to figure out, how to handle the growth challenges during the post real estate era. We see the residential price index continue to slide ever since 2020, ever since 2021, due to whatever sluggish demands and also the policy restriction. But fortunately, if you see, the second half, if you see, ever since the first half of this year and the second half of last year, the property flow space sales started to pick up, started to recover from the trough in the first quarter. Although it still cannot be comparable with the normal seasonality of last few years, but it's picking up. So that's the post arrow, the natural of post real estate, post real estate arrow. What does it mean? Is still lower, is still contribute less compared to previous cycle, but the key things, the key message here is recovering, also shows signs of recovering from the trough in the first quarter. So we expect, we are not gonna rely heavily on the property sector going forward, and that's the done deal. But also, on top of that, we don't think the drag from the property sector will be even bigger compared to last year. So that's the two key message. So the drag from the property sector will be relatively smaller going forward. That's a good thing if you think about that. We try to recover the whole economic growth from previous trough. That's the second challenge. And the third challenge apparently is the global environment. The global environment, especially in developed economies, for example, United States, is still facing a very high inflation, meaning that the central banks will need to tighten more aggressively to fight inflation. That will cause, for example, the surging yields and also the appreciation in US dollar. Normally, it will cause hardship of the currency for emerging economies and potential fund outflows. That's kind of an environment we cannot change, unfortunately, in the second half, because the Fed, including the ECB and Bank of England, probably going to continue to hike. But that's going to give us another questions we receive from a lot of investors, that whether that's going to derail the rally for the Asia market, for the H-share market, because the external environment is still going to pose a lot of volatility or turbulence, especially given the Fed is still tightening. Well, one of the key things I want to say is, first of all, external environment definitely will have some impacts on Chinese markets, according to historic experiences, are reflected by the recent RMB appreciation. But the second thing I want to highlight is that it's not going to be the dominant as the dominant factor. I can give you a very typical example for 2017. If you look at this chart, the figure, especially for the gray line, which is the H-share Hang Seng Index, that tells us exactly the condition of H-shares outperformance of the US market and H-shares bull run during the period of fast tightening cycle back to 2017, rate hike with balance sheet reduction. Why we still can do that? That's the key message I just said about the dominant of what is the real dominant factor for Chinese equities. Although external factors, for example, Fed tightening, will have certain impacts on H-shares, on A-shares markets, while the channel of sentiments, risk appetite, or even fund flows. But as long as Chinese economy is recovering, and also, the even better is leading global economies, is even stronger than global peers. It can weather through, it can offset all the negative impacts from outside. 2017 is a very typical example to show the case why and how Chinese markets can offset the Fed's tightening to still receive notable foreign inflows, to see the RMB appreciation, to attract more inflows for relatively more returns, better returns compared to other global peers. So that's actually echoes the trend of the divergent economy cycle I had highlighted at the very beginning of my presentation. So at this time, yes, we have to say that external environment is not very friendly, it's still challenging. But the key things you want to focus is China's economic growth. If the Chinese economic growth can slowly, stabilize and pick it up in the second half, for example, the third quarter or the first quarter, it gives you relatively advantages and better attractive return compared to other economies. And in that circumstance, even the Fed is about to continue to hike its rate. I think it won't stop the market to pick up or attract more inflows. That's the key. That's the key. How we offset. That's the key. How we try to fight against. How we fend against the external challenges. The market performance actually directly reflects the growth trend. You can see the growth comparison back to 2017 on this slide. We compare Chinese growth pattern versus the US. During 2017, China is leading global peers supported by a supply side reform and also Shantou renovation. Its growth has been so strong and even stronger to lead the global capital expenditure cycle. So that actually gives us a very notable comparison advantages compared to global economies. Even the Fed is continue to hike, continue to tighten during that period of time. We see the market continue to outperform. But if you look at 2019 is another example of China's growth. It's just a flattening. Its flattening is like an L-shaped recovery, given the backdrop the Fed is easing its monetary stance. But the Chinese market is just a fluctuating fluctuating without a very clear upward trend. So that is another example to show Chinese domestic growth is the key rather than external factor. So we have, we have looked at all those three challenges. We have to say that there are still challenges, but there are also improving signs. So right now, if we combine all the things I just said together, we can see that Chinese market, is right now standing at the bottom of sentiments. There are always the pattern of how the market to rebound from its troughs. The first bottom is policy. The pattern is kind of very consistent over the previous cycles. If you try to find previous bottoms, the first bottom is always about policy, and then with more and more policies started to be introduced, we see the bottom of sentiments. Right now is the bottom of sentiments because the first quarter and the end of last year is the policy bottom, and right now is the sentiments bottom, and the next bottom, which is going to be a more sustainable confirmation of earnings, will be the growth bottom. So right now we are in between of sentiments bottom and growth bottom. So right now is the market is rally on the expectation of more policy to be introduced, on the valuation recovery, on the improvement of sentiments and risk appetite. And during that period of time, we are waiting for the confirmation of growth. And during that period of time, we're gonna see maybe some consolidation and challenges because you haven't seen the confirmation of bottom of growth yet. So it's totally it's perfectly normal to see potential volatility, especially the external volatility actually is kind of inevitable. But we have to know that where we stand. There are potential challenges, but we are poised for more upside. We are be alert for more opportunities. That's the rationale. Why we see the A-shares markets. We stay a little bit defensive right now. Watch for potential challenges, but pose for future opportunities. That's why we draw the conclusion. So the next thing we want to watch for is the earnings. We will have the August semi-annual earnings, earnings season soon. We expect the earnings gonna moderate from last year's high growth due to the lower base in 2020. The growth gonna moderate to a relatively single digit growth. It's going to moderate, normalize in 2020, but it's going to show convergence of upstream and downstream. It's going to show signs of stabilization in the second half, especially compared to the first half hardship. That's the earnings expectation. Valuation is still pretty attractive right now. Valuation is standing at a relatively low level. That gives us a very good reason to be relatively more bullish going forward. Valuation is kind of standing at a relatively low level if you compare to historical average, and liquidity condition is continued to be improved for both domestic monetary policy, but also potential foreign inflows. But right now, we're still gonna wait for more foreign inflows supported by the confirmation of earnings inflection point. Regarding the sector allocation, right now we suggest growth sensitive, growth stabilization theme remain the key theme in the near term, thanks to the potential policy beneficiaries. But going forward, we believe growth sectors especially with especially with the support of longer trends of Chinese growth, gonna still attract more attention going forward, because we have to bear in mind in the longer term, China's current growth phase is kind of a slow, shifting to a structural transformation, meaning that we still have to focus in the longer term for those sectors to represent the best part of Chinese economy, put it in a longer term historical backdrop to try to find the key theme of Chinese economy transformation, which is the consumption upgrade and also industrial upgrade. That's the long theme. That's the secular trends in China, on top of the near-term cycle of growth stabilization. So those two key themes, we believe, are still the best part to ride China's growth going forward. You want to find the best part, for example, new in China, we mentioned here the manufacturing beneficiaries, the potential beneficiaries of the Chinese supply chain and its upgrades of its manufacturing capabilities to show its comparative advantages among the restructural of global supply chain. So that's the secular trends, on top of the near-term cycle we want to highlight going forward. The quality growth, or put it in other words, the quality growth. And the wealth management and asset management is another big trend happening in China. Recently, the individual pension system just got introduced by the policymaker. We think that's gonna support the development, especially of the equity assets demand going forward. Is something like the 401k in the United States. I want to spend just a few more minutes on the H-share market. H-share markets share the similarities with the A-share market from the Chinese macro background and also the corporate earnings, but it still has its differences from the valuation and sentiments and fund flow perspective. For example, the first difference is that H-shares is apparently trading a more attractive or even a lower valuation. So from the valuation perspective, it's much lower compared to onshore H-shares, give you potential more upsides. The second thing I would highlight is the fund flows. The fund flow, apparently, Hong Kong market is affected by both southbound the domestic flows and also more affected by foreign flows. But you can see the gray line on the right-hand figure. The gray line is the southbound flows from domestic market to the Asian market. It continued to flow in ever since end of last year, throughout the first half, regardless of the market volatility. That's the representation, that's the evidence of the domestic monetary easing, more liquidity to promote more inflows into the Hong Kong market. So we define the market phase right now for Asian market similar as the Asian market is the valuation recovery supported by southbound funds. The Hong Kong market is trading at an even lower valuation. So that means you have potential more room of valuation recovery. And going forward, we wait for more foreign inflows. But foreign inflow, the prerequisite for more foreign inflows is we have to see the earnings to bottom out. But right now, we see more inflows to support potential valuation recovery and potential more room of valuation recovery compared to Asian markets. Southbound inflows always lead foreign inflows. According to historical experiences, if you look at 2016 and early 2019, they all share a similar pattern. So the southbound inflows is the bottom of valuation and sentiments, and the foreign inflows normally are the bottom of earnings and growth. So right now we're standing at the valuation recovery phase supported by southbound inflows. We are poised for more foreign inflows if we have the confirmation of the earnings. How we be posed for the potential recovery and what we suggest going forward. Our strategy is called about the sector allocation is called about the dumbbell strategy. It's like a dumbbell, right? On one side of the sector spectrum, we suggest for high dividend yield, give you a fixed cash flow return from those high dividend yield. If you look at H shares of those high dividend plays, they're still going to give you roughly 6 to 7% of dividend yield. The other side of our recommendation, or the other side of the spectrum, is what we call better quality growth. The growth part offering you a better growth potential and operating cash flow. So combine all those together, that means, we suggest you to search for certainty against the still uncertain macro environment from the cash flows, dividend cash flow and operating cash flow. So the dumbbell strategy. That's our key recommendation for the H-share market. And that is also, how the market actually react over the past few weeks. Growth sector actually saw very notable rally from this trough. And we believe there are probably more legs to run going forward. Although, we want to remind you that there might be consolidation or challenges facing the potential, volatility in the U.S. market of developing economies. But we are still relatively positive, and we want to say H-shares are going to show its relative resilience against the external environment. All right, so that's really all my key message and for today's presentation from Chinese macro background, Asia market, sector allocation, and H-share market. I hope you find them useful and helpful for investment in Chinese market going forward. And with that, I will hand over to you, Isabelle. Thank you.
Thank you very much, Kevin. That was extremely insightful. We'll be back with Mr. Kevin in just 2 minutes for that Q&A session. But I just want to remind you to tie it all in together, that Mr. Kevin Liu, he mentioned H-shares resilience for the Chinese market and also the southbound flows. Just a reminder, we do have many index warrants on the Hang Seng Index at Kenanga Investment Bank. They are about 9 call warrants for the HSI, 9 put warrants for the HSI, and we also have 4 as well on the H shares. Because Hang Seng Index, it is predominantly dominated by these H shares, right? We've got Baba, Meituan, Tencent, and JD.com. So do check them out. I'll share them with you during my session later on after this Q&A session. So remember to ask all those questions right now, because we do want to ask Mr. Kevin some questions at this point. So Mr. Kevin, have a stretch and let's get back to it. Remember, HSI index, it is predominantly made up of H shares. So this is very relevant to everything that Mr. Kevin has shared about just now, especially with his slides on resilience and how they're being tied to, from an investment linked to a more consumer-based market. Fascinating. Thank you, Kevin. Let's go through these questions. All right. Let's see. We'll start from the top. Wei Ming Han has a question. Will China go into another lockdown if there's another outbreak? Can they afford to? And are they still adamant on a zero COVID strategy?
All right. Yeah, that's a very good question. Thank you. I want to talk a little bit about the policy and potential disruption of the COVID condition here. Yes, we are still going to be, the bottom line is, I think the zero COVID policy is still going to be there for a while, given the Chinese condition, the huge population, and also the potential risk for the elder people if we face, another wave of the COVID resurgence. So that's, how we handle the COVID condition in China. But, the strategy right now is adapting itself. As I said, they are using different cities adopting a regular testing, very frequently testing to try to avoid the extreme cases of another lockdown, especially for those key cities. For example, in Beijing, we are required to test every 72 hours. They try to use this regular testing, try to figure out, try to find the weak link as soon as they spot the potential sign of another round of resurgence. Yes, that's gonna still cause some disruption in economic opportunities. For example, I haven't been traveling since February until now, but the bottom line is, with that regular testing being there and probably gonna be there for a while, I don't see the chance of another very extreme lockdown, kind of a possible going forward. That without, with that being excluded for the possibility, I think the worst case in the economic growth, especially in those key cities, will probably be already behind us. So to sum up, yes, there's still going to be a very long tail effects, but the worst case is probably already over.
Glad to hear that. We always like to hear that the worst case is over. That means the market has hopefully bottomed out as well. From Mr. Seong Kok Tan, hey, always attending our webinar, Seong Kok. Good morning, Isabelle. Great to see more invites for a speaker from China, Hong Kong to share their market. Suggest to have it monthly since the market changes rapidly. This is up to you, Kevin. Do you want to do monthly webinars? Is your call. But that's just a comment. Chai Li Yun?
I'm glad to do that.
Oh, yeah? All right. Mr. Seong Kok Tan, your wish may be Mr. Kevin's deliverance. Chai Li Yun is asking, has China government allowed US-listed China companies to comply with US audit requirements to avoid delisting?
About that, we have seen quite encouraging developments regarding the cooperation of two regulators from China and the United States. According to the recent, disclosure from the official channel, China's regulators are actually trying to find ways to cope with U.S. regulators' requirements to, apply certain, for example, audit, disclosure requirements, so that, for those U.S. listed Chinese companies to continue to meet the requirements to list there. So the key message here, I want to say, we believe there's always some way to find the way to compromise and cooperation going forward. Although the timeline is still uncertain, although the timeline is still highly depending on how they negotiate between two regulators, but I think the bottom line is there's going to be a deal somehow to a certain extent, but to what extent, for example, the Chinese regulator can allow those key companies to provide their audit details is still uncertain. But there's going to be, our best case scenario is there's going to be a deal to avoid the full breakup from this, U.S. listed Chinese companies' perspective. That is also another reason why we see that the downside risk, the tail risk, could be eliminated to a certain extent if you think, if you look back the troll back to mid-March, when the market are quite concerned of the potential delisting risk from the United States. Not to mention more and more companies going to return to Hong Kong for secondary listing to just try to find alternative pace to prepare for potential tail risk.
All right, that leads perfectly into the next question from Noor Mohammed Yunus. He's asking, in that case, which sector of 8 shares would you advise investors to look at? Or I'll just further his question a bit, any particular stocks or companies that are your favorites?
Mm-hmm. Great. Yes, our strategy, as I mentioned, is what we call like the dumbbell strategy. The dumbbell strategy, the whole idea behind that is to search for certainty. The certainty we want to get, we want to provide for investor is, with the companies to provide at least quite, certain cash flow with relatively solid balance sheet. Because whenever you face the uncertain environment of growth and inflation, or even stagflation globally, the first thing you want to do is try to find still certain cash flow return. Either this cash flow from the fixed dividend pays, or the cash flow from those still quality growth, meaning that they don't require too much, support from the overall macro environment. If the Chinese economy gonna show more signs of growth bottom going forward in the second half, we can add more exposure to the growth cyclical sensitive part of the sectors of the market. But right now, I think the dumbbell strategy, the high quality growth and high dividend yield are still the best strategy feasible for investors to weather through the still uncertain macro environment. Meaning that we suggest for investors to watch for example, internet, select consumption, select healthcare equipment, auto, and even some catering business to bottom out from the previous trolls, and also to benefit from the potential easing of regulation and uncertainty of the external regulation challenges. That is the idea, how we try to ride the recent rally. So the still good growth potential, the relatively low valuation, and also the pickup, the improvement in the sentiments.
Understood. The China government likes to do it. It allows the sectors to boom and then restrict them, and then boom and restrict them so the market doesn't overheat, just like Western markets where they just go on a 50-year bull run, right? But you mentioned things like consumer stocks, tech, and auto. We've seen BYD fly sky high. Are there any other companies that you are looking at the moment that you feel have been pummeled down but with extremely good value for investors?
Mm-hmm. Well, I have to say I'm not expert for stock selection. From the strategy perspective, I'm more kind of a sector allocation guy. So I'm probably not in a good position to provide in the individual stock recommendation. But fortunately, for CICC, we have a top strategy from a top-down perspective for topics for both A and H shares, which is public available by Wind, a data provider, database provider in domestic China, and also we provide that in our weekly reports. And for different sectors, for example, auto sector, our sector analysts also provide their recommendations, which we believe could be a better resources for investors if they're interested in specific sectors.
Wonderful. Then in that case, perhaps I'll speak to your analyst and we can get down to some shares for our traders who are asking questions. I know from your sides, you are top view, you are big idea guy. You look at the world from 20,000 feet from above. But don't worry, for our traders who are listening, next week we do have our next speaker as well, Mr. Johan, who will be going into more stocks. But today, let's cover the big idea first to understand the fundamental winds that are affecting this market. So back to the big idea, CT Chan has a great question. What are the policies that target the slowing property sectors and tech sectors? How to counter the negative bias from outside of China? Or is China an insular market where they don't care about what the world is doing?
Well, if we want to understand, Chinese policy regarding the tech, regarding the property market, I think we have to put that in the context of China's long-term growth condition and a longer term, kind of a perspective to see where we stand right now in historical environment. And also we have to put that in the context of global environment. So China, after the boom of over the past 2 to 3 decades, riding on first the external trades since joining WTO, and also, riding the boom of the property market. I think the very fast growth, riding those two trends is kind of a slowing down. We already know that, right? Given the recent trend of slowing down in globalization and challenges in the external global trade environment, and also, the property market boom over the past 1 to 2 decades, and also the already high leverage ratio in China. We all know it's not going to be a sustainable way for China to continue to rely heavily on the property sector, or rely solely on the external demands. I'll put in other words, if we want to support China, we want to find a more sustainable pace for the next 3 decades, we have to find another way to support a more sustainable growth, which I believe, benefiting from China's first, the very huge population of middle class, and also a very well-established supply chain, and what we call engineered dividends, the consumption upgrade and industrial upgrade will be the 2 secular trends. So during that transmission and transformation, structural transformation period, you can feel that it's not going to be all this way very smooth transformation. Not to mention, there are always external challenges. There are always external disruption that will give us more challenging environment if, for the policymaker, want to make the transformation more smoothly. That's the hardship we experience right now. But bear that in mind. I think the longer term trend are still quite clear, because we have to go there. We have to go that way so that we can we can at least secure the next 2 to 3 decades of more sustainable growth going forward. So put that in mind. I think property sector, why we said it's already post property sector era. That's the key. That's the whole idea. We cannot rely, too heavily on that. Although there are challenges, there are, notable drags for the economy. We see potential marginal easing, but I don't think it's going to be a trend reversal going forward. For the tech sector, it's the same idea. I think tech sector represents the future trends of China's growth. But the thing is, you don't want the sector to go wild without any proper regulation to be established. So the whole idea is with the proper regulation, for example, antitrust or other regulation, Chinese policymakers actually want to actually try to reinforce to strengthen their comparative advantages to be prepared for future growth, to make them more healthy in the future. Although that's gonna be show some cost in the near term, but the whole idea, if we look at in the longer term perspective, we probably can get the to understand why we do that and why we do that at this period of time.
Understand. With questions from Xander Kong and B. Wee Hui. However, for you guys, ask us these questions next week as they are company specific. Today we want to do a big idea approach. So from Yuk Long Liu, this ties in very well with your earlier question that you just answered, Mr. Kevin. How exactly will the China government stimulate the Chinese economy? And will this help boost the China stock market? Yes, of course. But the question is how or what possible scenarios or fiscal or monetary policy or any kind of policy do you think that China will use? What kind of tools will they use to stimulate the economy?
Well, we already seen quite a lot, to be honest, quite a lot of monetary easing ever since second half of last year. The PBOC, the Central Bank of China, actually cut RRR rate since July 2021 and cut RRR and LPR, the benchmark rate, for a couple of times afterwards, all the ways until the second quarter of this year. So I think monetary policy are already been easing for almost 1 year, and we expect monetary policy and liquidity condition continue to remain in the easing stance to support economic growth. But only monetary policy is not enough. Monetary policy only support the liquidity condition, but what is more is we expect for more physical support, for example, infrastructure investment, especially in those what we call new infrastructure investment, like the green projects, like the high-tech, high-end manufacturing, try to provide more demands from the physical side, from the investment side, and looking forward after the physical stimulus and physical investment, we try to expect for more non-government private sector, for example, household and also non-financial corporates to gradually pick up in their investment, which is a capital expenditure cycle I emphasize in the earlier part of my slide. So to sum up, monetary policy continue to be there. It's already been there for a while. More physical support is probably a done deal. And what we expect more is the supports from the household and non-corporate, non-financial corporate sector to try to invest more going forward. And on top of that, we probably see marginal easing of certain regulation, for example, property and tech sector, to try to support the development or try to provide offset for the downside pressure looking forward.
And our final few questions. I know our Q&A is running a bit over time, but everybody wants your feedback and insights on things, Kevin. So from Kim On Yi, any latest or interesting progress updates in the EV market, specifically for the China market? So this is an EV question on any developments that you may know about.
Right. I'm definitely not an expert for this area, but I can talk from really a strategy top-down perspective. First of all, China has a very huge market, consumption market for the EV. That is why you see China is catching up very quickly with global competitors. With the consumption market, very huge consumption market, with the well-established supply chain, that's are the core comparative advantages for China's EV industry to compete with global peers. That's the first thing. Second thing, if you think that really in the longer trend, the EV supply chain, the EV sector and its value chain are consistent with the longer term sector trend I just emphasized for China trying to boost its manufacturing capacity and try to do industrial upgrades, the developments. So I think it's going to receive more policy supports going forward. And thirdly, the EV supply chain will also, attract more inflows, attract more attention from the investor perspective, giving the rest of the part of the economy and the rest part of the sectors are still facing challenges. For example, the profit market slowdown, the investors and also, the market need to find a big enough sector or long enough value chain to be able to absorb all those liquidities, try to find more growth opportunities to at least to be a alternative for the property sector investment. So I think from the capital market perspective, it will also attract attention. But again, that's only just my view from a strategy perspective. I'm not definitely an expert on this part, but I think that's still one of the key themes going forward. Although it might be stretched in valuation from time to time, but that's still a key theme.
Perfect. So you've also answered Xiao Mui Yong's question with that one. Thank you, Xiao Mui Yong. From MK Tan, given that China will be the biggest global economy, is there a regulatory policy on the pace of IPOs to increase the sustainable width and depth of the market?
I think China's market and China's economy, including China's regulator, actually are very positive and encouraging what we call the development of capital market from two perspectives. First, try to encourage more equity financing and the very good function of equity market to support the real economic growth. Meaning that, giving the already high leverage ratio for the corporate sector, equity market actually provide a very good channel to support the financing supports for the real economy. If you promote more IPOs to raising capitals from the equity market, if you actually, provide a solution for very high leverage ratio to rely more heavily on the bank loan and the bond market. So that's definitely one of the key trends the regulator want to promote. And the second trend they want to promote is the further opening of the capital market, further opening to welcome foreign investors and to strengthen the connection program for both southbound and northbound. And also on top of that, Chinese regulators are trying to promote the development of longer-term investor domestically. For example, the pension system, the insurance company, and the individual pension system, they are all recent and very recent efforts to try to provide longer term and more value philosophy oriented investor to support the development of the equity market.
Thank you, Kevin. That's an excellent insight on the IPO markets. I do have one final question, though, that we'll just cover for today. From Xander Kong, what's next for China's digital currency, the e-yuan? As there's not much news since last year after the trials, which was rolled out in selected major cities in China. Since you're on the ground there in Beijing, any insights on this?
To be honest, the short answer is I haven't heard too much about that either, even from Beijing. So I guess it's probably not the top priority right now in policymakers' agenda. But I think China has very good environment if they still want to do that, to promote so-called digital currency, because we all know China has been leading the global peers in e-pay, in so-called e-commerce, and also the digital payment. We are actually, we don't use any cash or I don't carry any wallet with me for ever since 2018 or 2019. So it's all go online and a digital payment. So I think there are already a very established environment there. It's just a matter of time if they still want to do it. But I haven't heard anything too much regarding that, even in Beijing.
All right. Thank you so much, Kevin. If you do hear anything on the ground, let us know and we'll message Xander Kong on our Telegram.
Sure, certainly.
All right, thank you for that excellent session. That was Mr. Kevin from CICC Research. He's the managing director over there. If you have further burning questions, keep on asking us and we'll hope we can get Mr. Kevin to answer them. If not, we'll see him very soon to give you an update, because right now it is crunch time, isn't it? We see some stocks moving and everybody's getting a bit excited, hoping that the bottom out has already happened, and that we are actually being eased out of all that harsh regulation from the Chinese government. Thank you very much, Mr. Kevin. And everybody, please give him a round of applause from wherever you are. Team, help please, applause. Thank you, make some noise. Thank you, Mr.
Pleasure.
Kevin.
My pleasure. Thank you, Isabelle. Thank you, everyone. Have a good weekend. Thank you.